Imagine standing before a formidable castle, its strength undeniable, protected by a deep, wide moat. That feeling of lasting security. That's precisely what astute investors seek in businesses. Today, we're diving into Morningstar's insights on why moats matter, exploring how to identify companies with truly sustainable competitive advantages.
Yeah, it's a really powerful analogy for investing, actually.
It really is. Our deep exploration draws from Morningstar's robust analysis, real-world examples, and their expert methodologies, covering everything from economic moat ratings to valuation techniques and stewardship assessment.
They have a very structured way of looking at this stuff.
Absolutely. Our goal is to equip you with a powerful framework to look beyond fleeting headlines, understand what truly makes a business resilient, and help you spot compelling long-term investment opportunities. Forget quick fixes. We're talking about building enduring wealth. So let's unpack this. What exactly is an economic moat in the world of investing?
Fundamentally, an economic moat is a structural advantage. It shields a company from competitors, much like those castle moats protected against invaders, you
Yeah,
know?
okay, a structural advantage.
Exactly. It's all about sustainable advantages that let a company consistently generate and protect high returns on capital over many years.
Many years. Like
Oh,
how long are we talking?
often a decade or even two. That's Morningstar's sort of time frame.
Hmm.
It means their return on invested capital, their ROIC,
ROIC. Right.
reliably exceeds their weighted average cost of capital, or WACC.
So it's not just about current profitability, but the ability to stay profitable for the long haul. That's a crucial distinction.
It really is.
As Warren Buffett famously put it, the key to investing is determining the competitive advantage of any given company, and above all, the durability of that advantage.
That durability part is everything.
Companies with strong moats are truly wealth compounding machines because they can sustain these excess returns.
Yeah, and it's compelling, sometimes startling, to see how quickly businesses without these defenses can stumble, even if they're popular right
Oh,
now.
definitely. Any examples come to mind?
Well, remember Nokia? Once a mobile phone giant, completely sideswiped by the iPhone.
Totally dominant, then gone.
Or Nintendo, Their iconic franchises are now battling really big shifts in the gaming landscape. These are companies that, well, they lost their edge.
Right.
Now, contrast that with an electric utility like, say, ITC Holdings. They've got a wide economic moat.
Why is that?
It's thanks to their dominant market position and a stable, predictable regulatory environment. Regulators only approve new transmission lines when they're really needed,
Okay.
and ITC operates with this transparent rate structure. It ensures they recover costs and earn a reasonable return. That leads to stable cash flows for years and years.
That's a powerful illustration. Predictable, protected.
And on the flip side, we've seen companies like those early ethanol producers, Pacific Ethanol, Verisun Energy.
Oh, yeah, I remember the hype.
Huge hype. But they rode that wave and then crashed spectacularly. Without genuine competitive advantages, that wonder product quickly became a money pit for investors.
Billions lost, wasn't it?
Billions. So understanding this helps you, the listener, see past that short-term market noise and pinpoint businesses truly built to last, not just those riding some fleeting trend.
Absolutely critical. Now, here's where it gets really interesting. Morningstar has identified 5 distinct sources that grant companies these powerful, sustainable advantages. Let's start with the first one. Intangible assets.
Right. These are the non-physical things like strong brands, proprietary patents, and crucial regulatory licenses.
Okay, intangible. So how strong are these really? Like brands, for instance?
Well, it raises an important question. Take Starbucks. They charge a premium for coffee, which is basically a commodity, right?
Right.
But it's not just the coffee. It's the whole experience wrapped around their brand. Luxury automakers like BMW, similar thing. They leverage this ingrained culture of quality to command high prices.
But brands aren't totally bulletproof, are they?
No, definitely not. They aren't invincible. Consider Procter & Gamble. Despite huge successes like Tide Pods,
Huge.
they're facing challenges. Competitors are catching up fast in R&D, offering similar pod products at significantly lower prices. That's slowly eroding P&G's ability to charge those premiums.
So even strong brands need constant defending. What about patents and regulatory protections? Are they more solid?
Patents offer a more, let's say, direct form of protection, usually for a set period. iRobot, the Roomba company, they built a strong patent portfolio that largely shielded them from major competition for a long time.
Okay.
Monsanto, in agricultural biotech, holds a wide moat primarily through its patented traits. It's a lot like how patents protect breakthrough pharmaceutical drugs.
Makes sense. And regulatory.
Then there's regulatory protection. Think about casino operators like Las Vegas Sands or Wynn in places like Macau or Singapore.
Right. Limited licenses.
Exactly. Strict regulatory barriers mean only a few players get licenses, creating a highly profitable oligopoly. Or Grupo Televisa in Mexico with its government broadcasting licenses.
It's remarkable how varied these intangible assets can be. Okay, moving to the second superpower, cost advantage. This is for companies that can sustainably produce goods or services cheaper than their rivals.
Yeah, and crucially, this isn't just about, cutting corners temporarily. It's about structural efficiencies that are incredibly difficult for others to replicate.
So built-in advantages.
Exactly. Managed care organizations, health insurers like United Health, WellPoint, Aetna, they show this through sheer economies of scale.
How so?
Their massive membership base lets them slash administrative costs per member and gives them huge leverage to negotiate better pricing with hospitals and doctors.
Okay, scale helps there. Any other types?
Definitely. Think about geographic or resource advantages. North American Class I railroads like Union Pacific or CSX, they have wide moats because they are, quite simply, the lowest cost option for moving bulk freight over land where there aren't waterways.
Much cheaper than trucking.
Oh yeah, like 4 times more fuel efficient and better use of manpower. Or think about companies located closest to customers. For heavy, low-value stuff like construction aggregates, that location is a cost advantage.
Got it. That brings us to the third moat superpower, switching costs. These are the sort of hassles or expenses a customer faces if they want to switch from one product or service to another.
Big ones sometimes.
Think about it. How hard would it be for you personally to switch digital ecosystems, like from Apple to Android or vice versa?
Oh yeah, that's a classic example. Apple customers face considerable switching costs within that iOS ecosystem. All those purchased apps, the media, just being familiar with how it works.
It locks you in a bit.
It does. And in professional settings, it can be even stronger. Take Cerner, an electronic healthcare records provider.
Okay.
Their systems become so deeply embedded in a hospital's daily workflow, doctors, developing habits around e-prescriptions, test ordering, billing, training staff, that switching becomes this monumental, costly, disruptive task.
Wow, yeah, I can see that.
Similarly, large asset managers like BlackRock benefit from what they call asset stickiness. Institutional clients face significant costs and risks when moving huge sums of money. It's just easier and safer to stay put sometimes.
Makes sense. Okay, number 4 is the network effect. This is when the value of something increases for everyone, new users, existing users, as more people join in.
Yeah, this one's fascinating because it creates this virtuous cycle.
How does that work?
Well, online travel agents like Expedia or Priceline are perfect examples. The more hotels and airlines they list,
The more travelers want to use them because there's more choice.
exactly, which in turn attracts even more suppliers who want access to all those travelers. It's a self-reinforcing loop.
Ah, clever.
Tencent, the Chinese internet giant, built a massive, incredibly sticky platform with services like QQ messaging and WeChat, leveraging a user base of hundreds of millions. Everyone's on it, so you need to be too.
A powerful force.
Yeah.
But this effect can also work in reverse, right? The network can actually unravel.
Absolutely, and that can be devastating for a moat. The NASDAQ and NYSE stock exchanges illustrate this perfectly.
So, they used to be the places to trade.
They did. They commanded dominance because they were the central hubs of liquidity. Everyone traded there. But then came electronic trading, high-frequency firms, new tech-savvy exchanges like Direct Edge and Bets.
Okay.
And suddenly, their market share for trading the stocks listed on their own exchanges just plummeted over the last few decades. NYC went from maybe 75% market share way back when, down to like 30-something% more recently. Their network effect eroded.
Wow. That's a powerful lesson in how quickly dominance can shift if the structure changes. Okay, fifth moat source, and Morningstar says this one's newer but really insightful, efficient scale.
That's right. This describes a market that's kind of limited in size, and it's already effectively served at just one or maybe a few companies. This discourages new competitors because there just isn't enough room or profit for another player.
The market's naturally small, or the existing players fill it up?
Both, potentially. Oil and gas pipelines are a prime example. They're heavily regulated, right? New pipelines usually only get approved if there is a clear, demonstrated economic need.
Okay.
Existing pipelines are already efficiently scaled to handle the volume for that market. Plus, the massive capital costs to build a new pipeline deter anyone from trying to compete head-on.
Right. Why build another one if the first one works and can handle the demand?
Exactly. This also applies to certain geographic monopolies, like some privatized airports in Mexico, or even niche markets. Think orphan drugs treatments for rare diseases.
Ah, yeah.
A drug like Soliris faces very few competitors because the patient population is small, even if the market is lucrative per patient. It's efficiently scaled.
But this can erode too, right? Like the network effect.
It can. Look at the telecom industry in New Zealand. It used to be an efficient scale market, dominated by one player. But deregulation in the early 2000s allowed new competitors to enter.
And broke the scale.
Pretty much. The incumbents' mobile market share dropped dramatically, from nearly 70% down to around 30% over about a decade. New entrants carved up the market.
Fascinating. So moats aren't static. They can be built, defended, but also erode. Which brings us to, well, how do they change over time?
That's a key part of Morningstar's analysis. They don't just rate the current moat, they assign a moat trend rating positive, negative, or stable. This assesses how those competitive advantages are actually evolving.
So is the moat getting wider, narrower, or just holding steady?
Precisely. And it matters. Companies with a positive trend often show stronger metrics across the board. Better earnings growth, revenue growth, improving margins, higher ROIC compared to negative trend firms, or even the market average like the S&P 500.
And this is independent of just, say, how fast the company's growing overall.
Yes, it's specifically about the competitive advantage trend. It's compelling to see how some companies actively work to expand their moats, while others, maybe inadvertently, let them slowly erode.
Can you give an example of a positive trend?
Sure, some biotechnology firms like Regeneron or Seattle Genetics often exhibit positive moat trends. They continuously leverage their proprietary R&D platforms, share knowledge internally, and get better at screening and selecting successful drug candidates. This enhances their intangible assets, their know-how, their patents. Seattle Genetics, for instance, kept improving the linkers for its cancer drugs, allowing it to charge higher royalties and widen its moat.
So they're actively strengthening their core advantage.
Hello?
And a negative trend.
On the flip side, a pharmaceutical giant like AstraZeneca has, at times, faced a negative trend. They struggled with declining R&D productivity, finding it hard to develop enough new blockbuster drugs to replace older ones losing patent protection. Their moat was, arguably, narrowing.
It's clear that even strong moats need vigilant management. And that really highlights the role of leadership, doesn't it? This brings us to stewardship.
Absolutely. While a great management team isn't a moat itself, their decisions about how to allocate capital directly impact the company's competitive advantage, whether they strengthen it or weaken it.
Right. This sounds like where the rubber meets the road. How well management uses your capital, the shareholders' capital.
Exactly. Morningstar evaluates management's track record very carefully. They look at investment strategy, valuation discipline when making acquisitions, financial leverage, how executives are compensated, and they assign ratings. Exemplary, standard, or poor.
Okay. What are some signs of good stewardship?
Well, one interesting point Morningstar makes is about dividends. Paying dividends is the only way cash flow directly returns to shareholders in, well, cash form. And it often imposes this really valuable discipline on management.
How so?
Discipline. If you've committed to paying a regular dividend, you tend to be more careful about other spending, maybe less likely to overpay for acquisitions or pursue wasteful projects. You need that cash for the dividend.
Oh, interesting.
Plus, a robust dividend policy can attract long-term, stable investors, the so-called clientele effect. And Morningstar's research shows that companies without moats are significantly more likely to cut their dividends than wide moat companies.
Because the wide moat companies have more stable cash flows to support it.
Precisely. Think of Clorox. Their strong brands and intangible asset moat provide the stable cash flows needed to sustain their dividend year after year, even considering their cost of capital.
So dividends can be a sign of both moat strength and management discipline. What about other examples of good or bad stewardship?
For exemplary stewardship, think Coca-Cola strong leadership, clear long-term vision. Or National Oil Well Varco under its former CEO, who made really smart strategic acquisitions in key growth areas that created huge long-term value. Accenture got upgraded to wide moat partly because management was so successful at building deep, lasting client relationships, like 99 out of their 100 largest clients had been with them for over 5 years. That shows excellent execution and capital allocation.
Impressive. And on the poor side.
Well, we mentioned BlackBerry's management failing to adapt to smartphones. That's a classic. Dean Foods took on way too much debt just to pay a special dividend back in '07, increasing risk dramatically. Weatherford International had operational struggles, financial restatements, overinvestment. Siemens, despite a decent portfolio, struggled to drive strong profitability consistently. Inersis, a Latin American utility, had issues where minority shareholders felt diluted due to complex ownership and management decisions.
Yeah, those examples really underscore that even if a company has potential advantages, poor management can absolutely squander them.
It happens all the time.
Okay, so let's say you've done the work, you found a great business, it has a strong, maybe even widening moat, and it seems to have disciplined management. Fantastic.
Yeah.
But now, how do you know if you're getting it at a great price? Because, as we keep saying, price and value are two different things.
That's the million-dollar question, isn't it? This
Yeah.
is where valuation comes in. We need to estimate the company's intrinsic value.
Intrinsic value.
Yeah.
What exactly is that in simple terms?
It's essentially the present value of all the excess cash the business is expected to generate for the rest of its life. Usually you estimate this using what's called discounted cash flow, or DCF, analysis.
DCF, okay. Sounds complex.
It can be, but the core idea, as Morningstar emphasizes, is price is what you pay. Value is what you get. Your goal as an investor is to buy that great business when its stock price is trading at a significant discount to its intrinsic value.
Buy it for less than it's truly worth.
That's the goal. But estimating that intrinsic value, well, it's definitely more art than science. It involves making a lot of assumptions about the future growth rates, margins, reinvestment needs.
Which are inherently uncertain, right?
Absolutely. The future is unpredictable. So how do you deal with that uncertainty? Morningstar uses scenario analysis. They don't just create one forecast. They build a base case, a more optimistic bull case, and a more pessimistic bear case.
To understand the range of possibilities.
Exactly. It helps understand the potential upside and downside. They also assign an uncertainty rating to their fair value estimate: low, medium, high, or very high.
What does that rating reflect?
It reflects how confident or uncertain they are about their own fair value estimate. How likely is it that they might be wrong? It considers both broad market risks, how sensitive the company is to the economy, and specific company risks.
Like what kind of specific risks?
Things like potential regulatory changes, a major patent expiring soon, having too much business tied up with just one or two customers, maybe management that's a bit unpredictable, things like that.
Okay, so you have this range of values and an uncertainty rating. How does that help you decide when to buy?
That's where the concept of margin of safety comes in. It's absolutely crucial.
Margin of safety, meaning
Meaning you demand a bigger discount to your estimated fair value before you buy, especially if the uncertainty is high. The higher the uncertainty rating, the larger the margin of safety, the bigger the discount Morningstar requires before they'd give a stock their highest buy rating, like 5 stars.
so if it's a very stable, predictable company.
Like Coca-Cola, which has low uncertainty because demand for its products isn't hugely affected by economic swings, maybe you only need a 20% discount to fair value to feel comfortable buying.
Okay.
But for a company with very high uncertainty, maybe a bank heavily exposed to a struggling economy, like the National Bank of Greece example they used, you might demand a 50% or even larger discount before you'd consider buying.
So you need a much bigger cushion if things could go wrong more easily.
Precisely. It's not about perfectly predicting the future, because you can't. It's about understanding the range of possibilities and demanding that cushion, that margin of safety, to protect your investment if your forecast turns out to be too optimistic.
Yeah, it makes a lot of sense.
Mm.
Okay, we've covered identifying great businesses with moats, checking the trend, assessing management, and valuing them with a margin of safety. So does putting all these pieces together actually lead to better investment outcomes for you, the listener? Does it work in practice?
Well, according to Morningstar's own research, yes, it seems to. Their studies, looking back over a decade since 2002, show some interesting patterns. Wide moat stocks, on average, tend to exhibit less downside risk than no-moat stocks.
Okay, less risky on the way down.
Right. They also might have slightly less upside potential in roaring bull markets compared to maybe riskier no-moat stocks. But here's the key. Simply owning wide moat stocks in itself isn't necessarily the whole magic formula.
So just buying any wide moat company isn't enough.
Apparently not for generating significant outperformance. The real power, the data suggests, comes from combining quality finding those companies with strong, durable economic moats, with valuation buying them when they're trading at a substantial discount to their intrinsic value.
Quality plus price.
Exactly. Morningstar's data consistently showed that the wide moat stocks trading in the cheapest valuation group, like the bottom 10% based on price to fair value, delivered the highest subsequent annualized returns over the following years.
That's a really powerful combination. Did Morningstar test this out beyond just back-testing data?
They did. They created actual strategies based on this. Their Wide Moat Focus Index, for example, is a rules-based index that holds, I think, the 20 cheapest wide moat stocks rebalanced regularly.
And how did that do?
Over a significant period from roughly 2002 to 2013 in the book's data, it generated an annualized return of nearly 16%, which absolutely crushed the S&P 500's return of under 9% over the same time frame.
Wow, that's substantial outperformance.
It is. They also run real money model portfolios like the Tortoise, which focuses on more conservative, wide moat, maybe slower growing companies bought at good prices, and the Hare, which is a bit more aggressive, looking for faster growers, and might include narrow or even no-moat stocks if they're really undervalued.
And how those performed?
Both of them also significantly outperformed the S&P 500 since they started back in 2001.
So these strategies really seem to highlight some key investment principles for listeners, don't they?
Definitely. It boils down to thinking like a business owner, not just the stock trader, focusing on that long-term intrinsic value. Maintaining adequate diversification. You don't need hundreds of stocks. Maybe 20 to 30 well-chosen ones is enough, but don't put all your eggs in one basket.
Right.
Keeping a long-term horizon, don't invest money you'll need in the next, say, 3-5 years. And practicing low turnover, not constantly buying and selling, which saves on taxes and trading costs and forces you to be more patient and disciplined.
That disciplined long-term approach really seems to be the core message. It gives you a clear roadmap. Identify these enduring moated companies and then wait patiently to buy them at prices that offer compelling long-term returns rather than just chasing whatever's hot today.
Precisely. Avoid the trap of fleeting market fads. Focus on the fundamentals.
Okay, just to give people a taste of how varied moats can be across different parts of the economy, maybe we can quickly touch on a few sectors, because a moat in tech might look very different from one in, say, industrials.
Sure, that's a good idea. They look very different sometimes. Take the consumer sector, maybe tobacco. Companies behind brands like Marlboro Ultra or Philip Morris International, they enjoy wide moats.
Why tobacco?
It's a combination. Very strong brands, addictive products ensuring loyalty despite price hikes, massive scale in distribution and manufacturing, and significant governmental barriers to entry, like the whole FDA approval process in the U.S. It's hard for new players to break in.
Okay, multiple factors there. What about financial services?
Think about credit card networks, Visa and MasterCard. Wide moats based primarily on powerful network effects.
The virtuous cycle again.
Exactly. Every new cardholder makes the network more valuable to merchants, and every new merchant makes it more valuable to cardholders. It just keeps reinforcing itself. Plus, they have cost advantages. Processing one more transaction costs almost nothing, and trusted brands, which are intangible assets.
Makes sense. Industrials.
Yeah.
You mentioned railroads earlier.
Yeah, North American Class I railroads are a classic wide moat example in industrials. It's that potent mix of cost advantage, being the cheapest way to move bulk freight over land, way more fuel efficient than trucks, and efficient scale.
Efficient scale
But
because...
they basically operate as regional duopolies. The barriers to entry are incredibly high. Imagine trying to get the contiguous land rights needed to build a competing railroad across thousands of miles today. Almost impossible.
Right. Prohibitive cost.
Yeah.
Lastly, maybe technology. Software.
Software can have very strong moats, often from switching costs. Think about Intuit, the company behind TurboTax and QuickBooks.
Yeah, everyone uses those.
Right. Their software becomes mission critical for individuals and small businesses. It gets deeply embedded in workflows, often customized. Switching to something else is a massive headache, very costly and disruptive.
So you just stick with it.
You tend to. Plus, they benefit from network effects, too, as accountants and users all want to be on the same platform for compatibility.
So really different drivers of moats depending on the industry. That's helpful context. All right, wrapping this up. What does this all mean for you, the listener?
Well, hopefully, next time you're looking at a potential investment, you'll be asking deeper questions than just, what did the stock price do yesterday?
Yeah, going beyond the surface level.
If we connect this back to the bigger picture, understanding these economic moats, figuring out if they're stable or changing, and layering on that discipline evaluation demanding a margin of safety, it gives you this powerful
The
lens
lens, too.
to cut through all the daily market noise, all the chatter, and really focus on what truly builds long-term wealth.
So here's a final thought to leave you with. When you look at a company, are you seeing a passing trend, maybe some temporary hype,
Mm.
or are you seeing a castle built with strong foundations and a wide moat, designed to withstand the inevitable challenges over the ages?
Are you looking for just a popular stock? Or are you truly searching for a great business at a great price?
Thinking about that difference could genuinely shape your financial